All right, I do like to start off each show with a summary of kind of what we saw happening with the market. And of course, this chart, should be familiar with this, it's the S&P 500, right? Coming down in this case with that red line across the top. The blue line is the 200-day moving average. So there's some very significant things that have happened here over the last couple of weeks. First of all, we broke through the 200-day moving average, which is a big piece of a checklist for seeing a reversal of this downturn. Number two is we broke through that trend line for the first time since this thing started. Okay, and we're still above it, and we're kind of well above it. And then this week, we actually hit a new high that's higher than the previous high. So if you look at all the highs all the way down, they're all lower, right? They're kind of underneath that red line. And we've never had one that's exceeded the previous high. So this is the first one. It's around 4,100 on the S&P 500. We broke that 3 days ago. We've held it yesterday, held it today so far, as that goes. So good motion, lots of good things happening. And then yesterday we had one other significant thing happen. And that's what's called the golden cross. And so the 200-day moving average is the blue line. The yellow line is the 50-day moving average. And when the yellow line comes back up through the blue line, that's a good sign. A lot of people watch this. And so that's somewhat important as far as that goes. So it's got a fairly good track record.
Yeah.
Right?
But sometimes it has failed. And so I think they say around 72% of the time you'll end up higher in 6 months. So
and in my view of it and looking back, when I see the bigger downturns, it has had a pretty good track record. When you look at 2020, when you look at 2018's downturn, when you look at 2008 downturn, all of those has signaled a point to get back into the market where it would have gone higher. However, it comes in late, right? Because it's very slow moving. There's two big averages. And if you look here, if this is a reversal, and I'm not saying it is, it's got a lot of check marks here. I like it. But if this is a reversal, the bottom was in the middle of October. So it's pretty late, right? But it's another confirmation. And it's really one of the main reasons why we use the dip that's happening today in the market to kind of go back in with the rest of our portfolio money. We've had money in our bond portion and our stock portion moved out to ultra short-term bonds and T-bills, and we moved that back in. And so we're back into fully invested in our model. So if somebody is 60% stock and 40% bond or what have you, they're back into those pieces. We'll see how long this lasts. I mean, one of the things that's very interesting about this is just the fact that this is such a unique environment. And I've been talking about this, and that could be good, so everybody expects certain bad things to happen, but the pandemic and the pent-up demand could offset those. It also could be worse because of the pandemic that's created these situations. So it's a little difficult to look at past history and say, okay, these are all the things that have to happen. We just have to keep watching and seeing what's going on. But the overall price action is quite good. It's pretty decent here.
Yeah, and it's interesting because the different indexes have been peaking or hitting this golden cross at different times. The Dow hit it in December, so it's much earlier.
Yep, exactly. And that's another sign that you look for. You look for confirmation from other indexes to see that this overall broad motion is happening as far as that goes. And so this is a chart for this week. Each one of these little bars is 5 minutes. You can see the big jump here in the middle of the week. And that has to do with the Fed Reserve coming out, Chairman Powell doing the question and answer. And I watched the question and answer like I've watched the others. And really, it was kind of remarkable to me. He had some chances to be more aggressive, and he didn't. He talked about more things that I think were positive than I've seen in the past. I was expecting a very aggressive, hawkish question and answer period because they're trying to drive down the stock market to tighten up monetary situation. But I think they're seeing behind the scenes that things are doing pretty well. It's the first time he used the word disinflation, really, since this all started, which just means lower inflation.
Yeah, it's a bit of a weird word.
It is. It's not inflation. It's not deflation. It's in between. It's disinflation. But nonetheless, those types of things that he says are important. The market jumped onto those and moved upward. Now we're seeing a downward movement now, right, in Friday, and that has to do with the report that came out this morning on the jobs report. And it's really kind of an interesting mixed bag. And I'll show you kind of what happened here. And personally, I think that in order to understand this market, the way it's going right now, and what's going to happen with inflation, what might happen with recession, you need to understand the labor market. Okay, and I'll tell you why. But so this is the report that came out today. I've got a year's worth of data here, but we had 517,000 jobs created in January. Okay, that's pretty good.
Yeah.
Especially since the expectation for new job growth was 188,000. So that's the biggest jump since the pandemic that I can think of, percentage-wise. I mean, that's what working on 2.5 times higher than expected. So that's huge. And so you'd think, oh, the market would love that. Well, of course, the market dropped, and down 1.2% or something as we do the show right now. We're still live here, market's still open, but and the reason is because of the fear of a tight labor market, where the Federal Reserve might raise rates even further. And we did see the 2-year Treasury rate go up today, not anywhere near where it was at a high, but up nonetheless. And we saw that the futures markets guesstimate on where the Fed funds will terminate, where it will hit the highest point, went up to 5% today.
Yeah, and the odds for so everyone's kind of expecting that in March we're going to have another quarter point. But in May, a lot of the expectation before today was we're going to hold steady.
Right.
And so it was about 60% there would be no change to the rate. But now that got flipped to 60% that there will be an increase, a quarter point.
Exactly. And that's coming from this report, essentially. Because what happens, the Federal Reserve has a dual mandate. Create, full employment, and they have an interesting definition for that, but nonetheless, and keep inflation low. 2% on core PCE is the main piece. And so when the job market gets hot, it just means, hey, the Fed can just spend more time and energy and put more effort towards raising rates to kind of slow things down. So we'll see how that plays out. Again, the Fed funds futures rate is still kind of at 5%, which is a little bit lower than what the expectation is right now. So we'll see how that plays out. This is one of the other pieces that kind of bothers the market a little bit. And again, these things are kind of ironic, but because low unemployment seems like a good thing.
Yeah.
Well, 3.4% was reported today, which is actually lower than it was prior to the pandemic. You can see the job losses, essentially, unemployment skyrocketed during the pandemic because everybody was laid off. But it was at 3.5% before that started. So, good, tight labor market. And the other thing that worries the Fed is just the number of job openings is still really high. This is going back to 2012. And so you see there's like less than 4 million job openings back at that time. And now we have 11 million. And it is off of its high, right?
Yep.
So that's good. But all of those things are what is bothering the market right now, is just this fact that, when you have a tight labor market and you have all kinds of new jobs created and lots of jobs that are still being, open and what have you, you end up with a scenario where wages could grow, and that means that more inflationary pressure, and the Fed's got to come in and hit it harder with interest rates, which would then translate to more impact on earnings and eventually hit the stock market, right? Yeah. So, but here's my outlook on it. A little bit of a twist on this, because I actually see some really good things in this report. I would not be surprised to see next week be an okay week, unless there's just some awful earnings or something that comes along. Because once people kind of dig into this, so first of all, the labor force participation rate is continuing to go up, and it tied the highest point since the pandemic, 62.4%. So this is the number of people over age 16 that are looking for work or currently working. So 62% of all the people that fit in that category are working. Now, it was higher, 63.5, right? I know that doesn't seem like much, but every 1% is about 1.6 million people.
Quite a few people.
Yeah, we still got a ways to go. Now, it's going to be fascinating to see how this goes, but here's the key thing. Inflation is kind of bifurcated into two places. It's goods, things that we can buy, and TVs. Everybody's buying big screen TVs for the Super Bowl. They're on sale. So we're actually seeing deflation, lower prices in goods. So we're seeing markdowns in Teslas. We're seeing, all of these different things that are happening. But services, is where everybody's shifted their money. Chairman Powell talked about that a lot, actually, that services are still quite hot. And it's obvious. There's pent-up demand. We can go out to restaurants. We can go travel. We can go, fly in airplanes and those types of things. And there's still a lot of people that aren't doing that on a regular basis. And that's still coming, right? So that's still growing and growing and growing. That takes labor.
Yeah.
Right? And so we need more people. We need these people back in that were here before, because we actually have more job openings than before the pandemic. I mean, if we go back, that's what's kind of fascinating. Look, the pandemic had, 7 million job opens prior. We're at 11 million. And again, this is this pent-up demand. This is the money that was pumped out into the economy. And so, sorry, wrong way. And so that's, I think this portion here where the wage rate has come down is another big bonus, right? So participation rate coming up, we desperately need to see that. I think that's super important, because the more people that participate, the better. And we were able to create 517,000 jobs, and the average year-over-year growth in wages is still coming down.
Yeah, that's a good sign.
Unless you have a job that requires, and you would love to see that go up. But in an inflationary environment, yes, it's a good sign.
Yeah, and with this job report, they also reported that people are working longer hours. So they said on average, for a 40-hour work week, people are working 18 minutes more. And that seems like a small number, but that when the report says if you average it out from the workforce, that's 160 million more hours of work.
Wow, that's a lot of work. Yeah, and so I think it's really fascinating what's happening here. I personally feel like this report is more positive than the market is acknowledging at this point in time, because one of the key aspects besides inflation is recession. And so if you have more jobs, if you have, this more participation, that can help you soften that recessionary blow that might be coming. So I think, and personally, I think that's probably the bigger threat to the market right now is recession and how that's going to impact earnings. So let's talk about earnings real quick. This is a pretty cool chart. This goes way back to the 80s. And what it does is the green lines show how many companies in the S&P 500 on a percentage basis are reporting positive surprises. So the expectation was here and they ended up higher, right? And the purple lines underneath are how many had negative surprises. And so we're at half of the S&P 500 as reported so far. 70% of those have beaten expectations. That's better than I thought would happen, and it certainly seems to be better than what the market thought would happen, and it's partly why we're seeing this run-up in the market overall since earnings season started. And we've seen, like, Apple last night report and miss on revenues, miss on earnings, and drop after hours, but then once everybody kind of digested the data and really looked at what was happening and realized that a lot of their problems were production issues that were caused by zero COVID in China, which is temporary. Just before the show started here, Apple was at 2.9% on the upside. So, I think that the earnings piece is still playing out here. We'll see how this goes. But I do think this is a big piece that is continuing to support the market. You can definitely see there's a trend downward from what we had in the 20s. The 5-year trend of surprises is at 77%, according to FactSet. We're at 70. So it's not bad. We're doing okay. We're doing better, I think, overall than what the big money was expecting, at least from what I was seeing as far as that goes. So very fascinating time frame to kind of see how this plays out, but a good time to kind of really be paying attention. There's a lot to learn here in this type of market.